All right, so multifamily is changing. Rates are rising. People are seeing multifamily differently. Some people are retrading deals to get discounts. Of course, we have all these inflationary factors such as growth in population, incredible growth in money supply, 40+%. So inflation versus risk of deflation and recession. There's just a lot of factors going on. So if you have money in the bank, you could be losing your money just by sitting in a bank account at a tune of 8 to 20% per year, depending on what you believe inflation is. Well, my good buddy Feras Moussa is here today. He is a partner at Disrupt Equity. They have over 3,000 units. They've personally raised around 150 million, at least by the time this episode comes out. And so, Feras, welcome. How are you today?
I'm doing good, doing good. Just trying to keep my head straight with what all's going on in the market. So,
Oh, there's a lot happening. I know you're a busy guy. Really appreciate you taking the time to be with us today, and just want to kind of jump into it. And again, some of this stuff is just kind of happening day by day, and we're kind of watching what's happening, what's unfolding. But I think last time I talked to you, we had 4 deals under contract, and you had 6 deals under contract, and there was just a lot of stuff moving. So both as a buyer and a seller. So talk to us a little bit just about how you see multifamily changing right now.
I mean, it's been really interesting, right? It's absolutely shifting from a seller's market to a buyer's market. And so, I mean, we were just talking about this just 10 minutes ago. I mean, we are making offers now with things that we probably would not have done 2, 3 months ago, right? Not just on pricing, that's the obvious thing, but even things around terms and extensions. And actually, I was with a mastermind last week, and they were talking about one of the people saying that they're starting to see people come back with essentially financing contingencies, right? And other things like that. And so it's kind of interesting as to what's going on in the market. And people are looking to get deals done, right? And so it's really important. Can you get the deal done? You have some sellers that are in desperate situations that need to get out of their deals. And so, you know, it's interesting to see. There's a lot of, I guess right now, it's still price discovery is my final answer to you, Bronson. Still a lot of price discovery happening across the board.
I was with Ken McElroy this weekend, and he was talking about he's seeing some people where, like you said, there's price discovery happening, where there's a standoff that can happen right between buyers and sellers, where sellers look back and they say, hey, this was worth this much, this worth this many millions just a couple months ago, and now things are kind of changed a little bit. And so he's seen some people that they either renegotiate. We've renegotiated some contracts, and then sometimes there's even a rare situation where somebody walks away from 500K or a million of hard money, which is really painful. But I guess Ken's friend realized it was less. It would be better off to walk away from $1 million that's hard than to continue on in that deal. Are you seeing stuff like that as well too, where there's retrading and there's
There is
kind of renegotiating happening?
It's happening across the board. Again, we're selling and we're buying, and it's happening across the board. I think, and then you have kind of two different schools. You have the sellers that are actively buying and they get what's happening, and you have the sellers that do exactly what you're saying. Well, here's what my friend got 2 months ago, right? And they're not really in tune with reality, right? They hear about interest rates, but they don't realize how it's affecting the rest of the deal. And so, to your point, I mean, we have a deal right now where we had 750,000 hard, and on top of that, we renegotiated with the seller, and in turn for the pricing discount that we got, we actually doubled down and put another 450K going hard today, right?
Wow.
So it's about, if you're a buyer out there, it's about showing you're going to get it done, right? And so, for us, we're doubling down. We're going to close that deal because now it's no longer about losing 750, it's about losing even more, right?
Mm-hmm.
But we're able to get the better pricing to kind of really go back to our investors and show them something, and again, reduce risk in the deal. So it's always, and again, we've never retraded, but again, you let common sense speak to you, and most sellers get it, brokers get it, right? And it's about doing it where you have, hey, here's what we're doing, and here's why, and here's the data to back it up, and here's what we think is fair. Right, really coming at it from kind of an analytical approach, I think is probably the best way to go about it. But yeah, so okay, we were kind of torn, but do we do it or not? But we did pull the trigger. So
well, you have a very unique view, because like you're both buying and selling almost at the same time. We've had that as well. We're selling assets, we're buying assets, and it's interesting if you're a seller and the people, like you said, they're out of touch with reality. It's not like, hey, okay, I'm going to take the $1 million hard on a $30 million deal or a $50 million, whatever, and you're going to get more money or sell it for the same amount. It's almost like you're going to have to take you have to sell for a lot less in the future. So it's like, you got to work with that buyer, right?
And that's what as a seller, that's what as a buyer, you got to realize too. It's what is the seller's option? Unless they really, we have one deal where the seller didn't really want to sell. So we're kind of debating on what we want to do there, right? It's
Yeah.
so, but in most cases, the seller was already ready to sell. If they go back through the marketing process, they're taking on another 60 days of risk. And again, they're not going to get better pricing.
Yeah. Yeah, that's it. It's really
So
interesting because we've had a seller's market for at least the last 2, 3 years, right? We've had just
yeah,
an incredible seller's market. So let's talk a little bit about some of the factors that are going in here. Obviously, the elephant in the room is interest rates are rising. 85% of large multifamily debt is bridge debt. So typically 2 to 3 year debt with interest rate caps. What are your thoughts on, are you guys still doing bridge debt mostly? Are you like,
we
what are you guys
are,
doing?
this set of deals, right? And so a couple things, right? First of all, interest rate caps is the elephant in the room, right? Those things have gotten really expensive. We got an email last week that 4 of our other ones that we bought a year or two ago are all paying. So now we're actually in the money. So those become a valuable asset, which you don't really think about, but they do become an asset whenever they're performing, right? Someone told me, I was talking to another operator last week, and he said that their $50,000 or $75,000 cap that they bought like a year and a half ago is now worth $1 million. Literally, the cap, if you were to sell it on the market, it's worth $1 million. Interesting, right? To
We're in the
think
wrong
about.
business. We should just invest. It's
Yeah,
like buying options, right? And
exactly. And so, and again, we have some performing caps as well. But to give people like a data point, right? So we had a deal that we closed this past Monday, so exactly a week ago. Well, the Friday before, right? So really the weekend before that Friday was when all of the economic news came out about inflation being higher than expected. And so I literally went into the weekend thinking like, oh, I wish I had locked in our interest rate cap on Friday. I really hope it doesn't get repriced by Monday. And sure enough, from Friday to Monday, the cost of our cap went up 150K. Right. So, it's
wow.
something to keep in mind. So for us, we're going into deals. We don't typically go in super leverage. We don't go in 80%. Some guys are 80% or nothing, right? We typically are going in 75, 70 or even 65 is kind of where we are. So that helps. The other piece of it too is just going with plenty of cash. I mean, we have lots of reserves. Play it safe. We've done deals that were too tight. So we've learned through the school of hard knocks, and ultimately my investors will not be disappointed if I give them 1% less by making it a much safer deal for everybody. And so we're really kind of investor driven around how do we reduce risk and still continue to give, an attractive distribution. And so it's just,
Right.
lots of cash. And the thing I think most people don't know and don't really plan around is just what that refi really looks like.
Yeah.
All right. That's the biggest unknown. And so we
Yeah.
go in all deals 3-1-1. That's a requirement. But then
Yeah.
also we really play with where we think rates will be and what can we get on the refi, not just in valuation, because you see most guys will model it just on valuation, but really thinking through what does the DSCR look like, right? And that's where I see so many deals that get underwritten that their exit refi is a 1 DSCR, and no lender's ever going to give you that. They're going to ask your proceeds another 5 million to get you where they need to be. So
Yeah.
something to think about.
So for our audience, debt service coverage ratio is just how much debt you have on the property based on how much income that you're getting. And so I want to go back to something you were sharing, because I guess this is something that I think a lot of people don't see. I think it's Warren Buffett talks about rule number 1 of investing is don't lose money, right? And rule number 2 is don't forget about rule number 1. Like, it's that important. So I love that you guys at Disrupt are saying, hey, let's preserve capital. Let's do whatever we can to take care of investors. You've been doing that for years. But talk to me a little bit. I'm curious to hear what you think about this, or if you're aware of this. But the parties that are doing these interest rate caps, they're these third party groups. There's 2 or 3 of them that do most. I can't remember recall the names of them, but they're not large insurance companies, right? And we're talking about this is a multi-trillion-dollar industry. Do you have any concern of counterparty risk that if the interest rate caps, let's say rates went up to, I don't know, let's say SOFR goes up a few points, or it goes up a few percentage points. I mean, what does that do if, some of those interest rate caps are not there? Do you think the government comes in and bails out? Like, what have you? Is this something you kind of thought about a little bit?
Are you saying that the underlying holder can't service the interest cap?
Yeah. So these groups that, just for our audience as well. So an interest rate cap is like above SOFR, which is the overnight lending rate. It might be 2% above SOFR, right? So if it goes up above that, let's say we're 3% or a few percent above what the SOFR was at the time, or whatever, it just gets to a point where it's a huge amount of money they're having to pay out to help service, and they can't service them anymore. I'm not saying, again, I don't understand enough about that part of the business, but I've been kind of hearing that from
Yeah,
some people. It's an
I don't know.
interesting,
I don't
yeah,
know how how it's guaranteed behind the scenes, right? It
Right.
may already be resolved, right? Just like a regular insurance company around just regulation. I've
Right.
given no thought to that piece of it, but I mean, at the same time, I almost feel like it could always be looked at as a Ponzi scheme. These people are
Right.
buying caps anyways. Take that money and dump it in. I don't know.
Yeah.
You're right. I don't know. How do you ensure the underlying holder is able to perform?
Right.
Right.
And it was interesting. You and I were on a panel, or I led a panel with you and Michael Becker and Brad Sumrock. We were talking about this. And, Brad was talking about, typically rates rise on average for only 2 years. And then once they start raising rates, the clock is already kind of there to start lowering rates again. And so there's actually some people, one thing that came up in Belize is there are actually some people that are betting on options, believing that rates are actually at some point going to turn negative, which we have not had in the US. But if you look at the trend, it's just kind of come down and down and down with this debt-based system. It'd be interesting to see if something like that were to happen.
And I actually went and looked up the data over the weekend. I was trying to figure out how long had it gone on for, right? Because I've heard that a couple times, right, including that panel. Right. And I couldn't find an article, but I literally found the raw data points of the Fed rate since like 1960. So I kind of went and did my own little Excel, tweaking here and there. But yeah, 27 months is about the longest I could find that they continue to actually increase, right? And by increase, I mean like more than like 0.01, right? Something notable of an increase. And so that's the longest. And again, it's been shorter. So again, if you rule of numbers, right? Well, if I can make sure I'm in my deal for 3 years or more, right? Hopefully I get on the back end of all of this. So TBD.
Yeah, CBD, it's interesting. And I geek out on economics, and we were talking about this thing about how Paul Volcker at one time brought the rates so high to try to beat inflation, in the 70s and 80s. And Paul Volcker said that he would not have been able to do that today because of like how much debt is in the system and things. So it's just interesting. Like we look at, what's happening in multifamily and also what's happening on the macro level. I know you guys do that as well, and just seeing as far as what's happening. But what are some things that are changing as far as your underwriting? Like how are you guys underwriting deals a little different now with higher rates and with some of the changes?
Yeah, I think the two biggest thing is obviously interest rates. I mean, if anybody's underwriting a deal less than 5, they're probably doing it wrong, right? Unless you're going under the fixed debt, which you can still get under 5, right? Your rate is going to be north of 5, no matter what. And top of you have another 75, point increase coming up here in July. And so, most deals are closer to 6 than a 5, right, on the current. And then again, thinking about where do you think it's going to go from there? That's number one. The other big piece is what do exit caps look like? And so there is a loose correlation between caps and interest rates. And so, the fundamentals of multifamily are still there. And with inflation, you do get rent growth, arguably. And so how much do caps shift is the big question, right? And so what do you plan for that is another, I think, a big question for people to consider. And then the last thing of that is also, again, it's what I mentioned, really thinking through what does interest increase do to my refi. That's where people really don't think about it. I mean, higher interest rates on the refi means you're going to have a much lower DSCR. Really think through that. And by lower DSCR, meaning the lender's not going to give you that low of a DSCR. So you're not going to get the loan that you think you're going to get.
Yeah, no, that's really good. I think the underwriting is obviously just so critical that we're conservative. And even if we're projecting lower numbers, we're saying, hey, we're trying to, help keep you safe and make sure that, things don't go, you're preparing for that scenario that you hope doesn't happen. A question, I guess, this is for me as well. I know a lot of us, we're all doing bridge debt, right? We're doing, 3-1-1, or we're doing 3 years plus, a couple 1-year extensions. For a lot of these agency debt now to get more fixed long-term debt, the downside of that is obviously it's typically the LTV is you have to put much more down. And then secondly, you have yield maintenance if you have to sell early. Are those really the two primary things that the reasons why people aren't doing more of that, just in case? Yeah.
And I think the biggest reason, let's rewind. Biggest reason a year ago or 6 months ago even, right, was agency don't care about what the deal will do moving forward. They only care about what it's done, right? And on top of that, they don't care about CapEx typically, right? With Freddie, you can get some CapEx dollar, or Fannie, sorry, you get some CapEx dollars, but they don't, other than that, they typically don't care. So if you're doing some sort of value add, it's really, your leverage is going to be based on what the deal has done, and that's it. And so if you can get to where you need to be, great, but typically you're not. The other piece of it is exits. And again, we paid 6-7 million. I'm going to do the number sometime very soon to see if is it like 8 million or is it really just 6. But we paid a significant amount of prepays last year on deals we sold. And so we kind of learned. And so that's where my favorite type of deal is doing a floating rate with a tight cap. Now, tight cap doesn't really work right now because prices are just through the roof.
Millions of
But
dollars.
again, yeah. So I think those are the two biggest reasons, right? And so I think as a company, we're shifting more towards longer term, better deal type of holds. And so fixed debt makes sense, right? Because we're not in it for the next 2-3 years. We're in it for the next 10, right?
Yeah.
What does that world look like? And so things to keep in mind.
Yeah, so let's talk about that. I know you guys are, you've been doing this for quite a while, for a number of years. You've had 3,000 units. You said you just sold some recently. What do you see look like the next 5 to 10 years looking like? Because nobody has a crystal ball, and are we going to return to kind of what we saw the last few years? Is it going to look different? Do you think cap rates are going to go up, or what are some things that are going to happen?
No, I mean, I do think rates will go back down in 2 years, right? Now, I don't know what the next 2-3 years look like. I think ultimately, I think they're just going to plateau across the board. That's just my theory, but maybe that's my lazy man's prediction, right? I mean, I think right now it's choppy. We'll find the balance and kind of plateau there, right? Unless something drastic happens. But ultimately, I don't think cap rates are going to go back to 8 or 9 for multifamily. That's not happening, right? I don't think interest rates are going to go to 8 or 9 either, right? And so I think it's going to basically, right now it's going to stay jumpy, then it's going to probably settle back down. And if I was to, my prediction, SOFR will go back down to, 3/4 of a point, right? That's where we'll land, 4 years from now. Because again, with the increasing interest rates, the government's obligations get a lot more expensive also, right? And so, that's something to think about.
Yeah, that's something we were talking about a lot is in the macroeconomics, is just that the higher the interest rate goes, the U.S. government debt gets to be unsustainable. And so this is such a debt-based system. A lot of people, if you just looked at real estate in 2008, you could have lost your shorts, right? You weren't looking at kind of what was happening kind of in the broader scheme of things. And I think right now that's why, looking at macroeconomics, looking at government policy, looking at monetary policy, it's really important because that determines, they may slow down printing money, but they're gonna have to keep creating more money and more debt to kind of make the system work. Otherwise it doesn't work. And there's hopefully there's a reckoning moment somewhere down the road, but the more real assets you own, I think is probably better at some point. Do you have any idea, like, as far as, we don't have to go super deep, but as far as how that's gonna, are you have any concerns about the dollar, any concerns about just kind of the money printing?
I don't know enough to speak intelligently of the dollar versus everything else, right? I do think ultimately, again, it's in the government's no pun intended, it's in the government's interest to keep interest rates low.
Yeah.
Right. And so right now it's about, hey, how do we resolve inflation? And unfortunately, the government doesn't really have any other tools.
Yeah.
And so, but the other weird thing is they're taking this kind of shock approach to it all, the system, right? And so I don't know if inflation reacts that quickly, right?
Yeah.
And so we'll see.
It almost seems like they're trying to shock the system. I mean, to raise 75 basis points every single month, it's almost like they're expecting
a huge increase.
It's almost like expecting something to break. I mean, whether whatever it is, it's like there's going to be some industry that can't handle this, and all of a sudden we got interest rate caps, but some industries like we're screwed.
And so let's go spend money to bail them back out, and the circle of life continues, right?
Yeah, exactly. Well, let's chat a little. Let's shift gears a little bit. You guys have raised a lot of money from millions of dollars, $150 million. Gosh, that's a lot of money. What do you feel has kind of helped you to do that? And but let's talk a little bit about, obviously, your disrupt equity. Now you have all these events that you're doing. You guys are adding incredible value in different ways. What was that like in the beginning, and how did you kind of get started in that?
Yeah, I mean, I'm a big proponent of doing the thing that is too big, too hard for most people. That's just my, that becomes your value add, right? A way to differentiate yourself. And so that's been kind of a big part of how we think of things. And so, me and my partner, luckily we can, we have the same long-term philosophy, right? We're not in it to build a company for the next year or two. We're in it, how do we build a legacy company, right? And how do we build a company for the next 20, 30 years and make the right decisions up front to kind of help us get there. And so we've continued to dump money back into the company and really dumping it back into the people, right? And try to hire on the right people. I'm a big believer if I have the right team of rock stars, I can go do anything. And so we're really focused on that. And we're spending, even today till now, I interviewed 2 people today already, right? Hiring is a big part of it. getting the right people. That's kind of where we are as a company. But at the beginning, it was really, you have to roll your sleeves up. And I think people are infatuated with this concept of entrepreneurialism, right? It's the sexy thing everybody wants on paper, but people really ignore the late nights and, the
Yeah.
grind and the stress. Even now, I mean, hey, we're juggling 6 deals. It's stressful, right? It's a lot.
Yeah.
I feel like I need to write the book on how to eat an elephant because, how do you slice these deals up in the way to make it to where it's palatable? And so really being aware that with any business, you're typically going to have to scrap yourself by. And I was actually talking to, an accountant, and I was saying the accountant's always the last thing you think as an entrepreneur. You're working through everything else, and accounting is just the afterthought, right? And it all gets cleaned up, and then, but it's nice because now we're full past that, and our stuff is really clean and elegant and organized, and you have people dedicated to each problem. And so
Yeah.
I think it's really think through a way that can differentiate you, right? Drive that, but at the same time, be willing to hop in any role, right? As you kind of continue the growth. And the last thing I'll add too, because people ask me this often, you get to a point in any business where you have to cross a chasm, right? And there's a book literally called Crossing the Chasm, which I have not read the book yet. I want to, it's on bookshelf, but I think I already know what it's going to talk about, right? And it's, you reach critical points as a company where you either have to leap or you're going to fall, right? And I remember several of these inflection points where, I went to my partner, Ben, I'm like, hey, here's where we are, here's what's going on, here's what we're going to have to do to get to that next step, right? And one of them was we closed 3 deals in 45 days, and but before that we had to make the conscious decision we were going to really grind it out, find underwrite an insane amount of deals we can to find the right deals and work through getting them to the finish line, because that would give us enough to go hire a full-time asset manager. Because then people end up buying several deals and they get lost in buying deals and they never grow, right? You see that all the time. Many people get to the 4 or 5 deals and then they disappear, right? So that was one of them. We had another one of them during COVID, and even now we're at another point. So it's kind of hit these different inflection points, and you have to take that leap, but do it with a plan. So
Yeah, I love that you shared that because a lot of people, and I think myself included, definitely included, is I was doing single family and I was kind of doing it myself. And I had a, realtor and I had a property manager, but it was really just me. And I realized multifamily is such a team sport. And it's really, really important that if you want to grow, and even as a passive investor, I mean, you're really trusting a team of people to help make you money and mitigate risk. And sometimes you have multiple teams of people that do that. But even as a passive investor, you'll have a CPA, or you'll have maybe an attorney, or have other people kind of structure different things for you. And it's just amazing how, when you look at building a good team, having the right team members is so, so, so important. And I've seen that. I know you guys have a big team. You guys do a bunch. You could do 3 or 4 events a year that are just amazing events. I encourage everybody to check out Disrupt Equities events. Occasionally, I share at some of those events, or I go to the events. And I mean, in Houston, it was an amazing event. They had 600 people in a room. You guys have one coming up in Seattle and Atlanta. So really excited about what you guys are doing. Let's talk a little bit about the events. Is the purpose of the events you're gathering investors, creating value? Because I know it's a ton of work to put together an event. But talk to me a little bit about kind of what that does for the business and what that does for investors, and kind
yeah,
of what you're doing there.
well, it's funny. So initially, the thought process was, hey, we can help find more investors. Do we find investors? Yes, but really, you find partners more than you find
Mm.
investors, right? And the other two other unintended consequences, right, is that it's brand building, which we kind of knew, right? But it's brand building with association, right? And so, for example, we got the mayor of Houston to come out 2 years ago. Well, now we've elevated our brand to to the level of the mayor of Houston, right? And so
Wow.
it's that kind of thing, which is actually pretty powerful. The other really big thing is that it actually gives me a platform to put people on that we like. Right. We have a lot of people that approach us wanting to, there's sometimes people we like, we want to put on, they're just not a good spot for them. Right. But then, it attracts people wanting to participate. And in turn, right, it's a way to add value to people that I may not be able to add value in other ways. That's maybe what I'm trying to go with that. And so, even then again, the mayor of Houston, there's not a lot of ways I could add value to him. Right. But putting him in
Right.
front of a bunch of, that's adding value, real value. And so, he knows who Disrupt Equity is and vice versa. Right. So, those are the kind of big things for us. It started off with an idea. It was kind of, hey, there was just no neutral party in Houston, right, at the time, and no event,
Mm.
right, where it's not associated with any group or anything. It's just, hey, come one, come all. That's always been our MO. Our goal was never to make money from it. We lost 20 grand on the first 3 each until we kind of figured it out.
Right.
And now our goal is to break even. I mean, we don't sell anything.
Yeah.
We've literally had many people that come up to us and like, hey, I'm surprised you didn't try to sell me something, right? And that's not the
Hmm.
goal of our events. And so we bring on, vendors, partners, people we've worked with, people we like, and just that's our way to add value to the community.
Yeah, it's amazing when you do events. We do a live meetup in Pasadena every once a month on a Wednesday night. We'll have between 40 and 80 people usually show up, and it's it's a small door charge, but we don't sell anything. It's actually called For Investors by Investors. So we literally are like trying not to sell anything because we've all been in the run in the back of the room, like, oh, I've only got this many tapes, and how many we got, and they're this amount, or you got to do it right now. And I think when you do real estate, really looking at it from a partnership, just like you said, we're looking for partners, looking for people to partner on deals with, whether it's actively or passively or helping people. It's just amazing how when you bring abundance to the community, abundance comes back. And so I think that's probably also part of the reason you've been able to raise so much money, because it really puts you, sets you as a leader. You're creating, people get paid for creating value. So you guys are creating a ton of value with that. Let's talk for a minute. Feras, tell us a little bit about your life before multifamily. I know you did a computer science degree, and do you have some other things that you did before you kind of got into multifamily?
Yeah, I mean, so for me, I had always been an entrepreneur at heart, right? I mean, literally from high school, the first money I made was on a game where a guy literally mailed me a couple $100 bills in the mail, which I didn't think he would do. And then in hindsight, I'm like, man, what was I thinking in middle school, giving some random guy on the internet my address? But he did mail me. I, learned about that, and then that had turned into my own little web company in high school where I was making, web pages and websites for people, and then I started making them for myself, and the rest is history. So I kind of got that tech acumen. Ended up randomly going to career fair in college with friends. I was the only person that had actual experience to talk about, so I got introduced from all the companies. And first interview I ever did was with Indeed.com. They were a much smaller company at the time, and it's funny because the very last interview is with one of the two co-founders, and he told me, you aced the interview, but I can't hire you. I'm like, wait, why? It's like, because I need someone that's going to work here long term. Because I had asked a question about why do you want to work here, and I was like, well, it looks like you guys are growing from small to medium, and I want to have my own company someday and see that happen. So light bulb went off. Okay, this is why people hire interns, right? You kind of change your, but always been kind of down that. And so Microsoft happened, interned there, went full time. Great people, great team, and always knew I was going to leave and do my own thing. And fast forward, I left, had a software company, and then found out about real estate and realized it's things that I love, people's numbers and systems. So
yeah, no, that's great. I can see, it's amazing how we can bring what we did before to our business now. A lot of people, people are going active in multifamily. They wonder how they're going to make that transition. And I was medical sales, so I sold, well in medical sales. Now we've raised 27 million. So it's been just a process and all that. But Feras, talk to us a little bit about, how you see investors should be preparing right now. What are some things people should be doing or looking at, or whether they're passive or active, just kind of in the market right now? What are some things maybe to watch out for this?
I mean, I think there's still a lot of cash in the market. It's sitting on the sidelines right now, but I don't think it's a situation where there's just not cash, right? A lot of people got nuked in the stock market. And unfortunately, a lot of investors sell their stocks to go buy real estate. And so if you get nuked in stocks, you're probably not selling right now, right? But I think if you are an active buyer right now, it's really about looking at the quality of the asset, right? Again, it's shifting to a buyer's market. And so even us as a company, our kind of strategy moving forward is really newer deals, newer locations, better locations, right? And hold on to them. And so that's one thing. The other big thing is just your leverage, right? Leverage, you hear this all the time, where the leverage is at and what the risk actually looks like. And so people need to be aware as to, and unfortunately, most investors don't understand this, what risk adjusted returns mean. Not just returns, but what are your risk adjusted returns? And I think that's just those two things, and then last but not least, I think it's going to be an operator market, right? And so tight operations is going to be important right now, right? And making sure you are invested with someone that's getting ahead of it, that understands where things are at, and making the right hard decisions, right? Even if we do monthly distributions, right? And we have a deal that we bought in December that's, hey, we're about to start distributing on, but now it's like, well, hey, do we just wait a little bit and just build up more reserves, right? You just don't know with the uncertainty. So being within an operator that's willing to make that decision. So
yeah, that's a lot of good stuff, and risk adjusted returns, being aware of leverage, and just lots of different insights on the market. Well, Feras, I want to say thank you for coming on the show today. I've just always appreciated you and Ben, and how you guys add so much value, particularly through your events and just the ways you're just so abundant. You want to give back, you want to help other people. It's very apparent. And obviously that's why you're having so much success and also from your level of just being very tactical on how you approach the market, really looking at things from a very practical approach as well as a very safe approach. But thanks for coming on here. What are some ways people can get in touch with you?
Yeah, you can check out disruptequity.com or send me an email, Feras, Feras at disruptequity.com.
Awesome, man. Well, thanks for coming on. I'm looking forward to seeing you at an upcoming event, I think in Atlanta, and just so appreciate all you're adding to the marketer.
Thanks for having me, Bronson. Appreciate it.
All right, so Feras is somebody that I really admire. I admire the things that he's doing with his life. I admire what he's doing with his business. I admire just what he's talking about. Because again, you look at what he's doing is he's adding value to people's lives, right? He's going in and he's saying, hey, how do I create value? So by putting an event together, it's a ton of work. They even lose money. Even the events that we do, our meetups, we lose money on it. But we do it because we want to add value to people. And we realize as we do that, there's value, there's a reciprocal kind of relationship that's created. And sometimes maybe we could do a deal together and create even more value together. A few takeaways that I had is he talked about risk-adjusted return. And it's really important to know what your risks of a deal are going in. Every deal that we do, we're busy doing lots of deals. Recently, we had 4 deals under contract. We've got 3 under contract right now. We closed on one, and we're closing on one this week at the time of this recording. But understanding in every deal, how could you lose money, or what could go wrong, or what could be not as appropriate. So sometimes we're trying to make projections a little bit lower just because there is some uncertainty of how things will look going forward. I still am really big on, hey, I think if you have cash, it's good to deploy a fair amount of it because you want it working for you, right? You don't want it sitting there. There's a high carrying cost. There is a conversation around having some dry powder that in case there's deals or things out there, you can take advantage of them. But there's this idea that Grant Cardone talks about is just continually going broke, continuing to go into deals, putting money out there into deals that you know will work for you, or your money works for you, rather than sitting in the bank and losing 8 to 15 or 20% per year, whatever inflation really is. So anyway, I love that. And I love the idea of team. I loved how he has built an effective team around him. And if you're a passive investor, your team may not be, hey, I hired an event coordinator or I hired an attorney. It may be like, hey, I have a really good CPA, or hey, I've got these 2 or 3 groups that I really like that I can invest money with, right? So if you're interested in kind of doing deals with us, we're constantly doing deals. So we've got our ATM machine fund that opens a couple times a year. We just closed that, but we'll open it up again in the future. That's partnered with the 5th largest operator of ATMs in the country. Love talking about that. And then we're constantly doing multifamily deals. So if you're not on a list, check out our website, bronsonequity.com. You can join our investor club. We'll start a relationship with you. But anyway, I hope you enjoyed this episode. I really enjoyed it. Look forward to seeing you on the next show of Mailbox Money.
You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.